Good morning. Today we are going to discuss the time value of money. See, the time value of money is generally estimated by using the concepts of present value and the future values. So we will discuss in detail all these concepts. See, we must have heard that a rupee earned today is worth more than the rupee earned tomorrow. Which means that money is available today will be the worth more than the same amount in future due to its potential earning capacity. Do you think why it is so? Let me explain one example. See, your father is decided to gift you 1 lakh rupees at the end of 5 years, and also given another option, that is, he gave you a choice of having 80,000 rupees today. What choice would you make? Would you have accepted the 1 lakh rupees after 5 years or 80,000 rupees today? What do you say? See, of course, the 80,000 rupees today is much more attractive than 1 lakh rupees after 5 years. Because present is certain than the future. You can also invest this 80,000 rupees in the market and earn the return on this particular amount. Therefore, we can say that 1 lakh rupees at the end of 5 years would have less purchasing power due to the inflationary situation in an economy. I hope you got the message that a rupee today is worth more than the rupee tomorrow. But the matter, money is not so simple. The time value of money concepts will solve the puzzles of such a choices which we all face in our daily life. So the understanding the time value of money is crucial for the various financial decisions such as investment analysis, capital budgeting, loan structuring and restructuring, and determining the fair value of assets. The time value of money can be expressed as the present value or discounted value, or we can also represent in terms of the future value, or which is also known as it is compounded value. The present and future values are the term which are generally used in the financial world, especially to calculate the future and the current net worth of money which we have today with us. Let us consider one simple example. See, Mr. A is invested rupee 100 in bank at the rate of 10% for 1 year, and it become 110 after 1 year because the rate of interest is 10% for the 1 year. From this particular example, see, this 110 is the future value of 100. This 110 is the future value of 100 after 1 year. Similarly, we can say that this 100 is the present value of 110 which is to be received after 1 year. So therefore, they are just reciprocal of each other. See, the present value and the future value calculations are used to evaluate the worth of future cash flows and the growth potential of investment over the period of time. I hope you all are clear about this particular concept of present value and the future value of money. We will discuss in detail about these topics again. See, what actually the future value means. See, let me explain here the meaning of future value. See, the future value simply means the cash value of an investment or any particular amount at some time in future. Or we can say that it is the value of today's sum at a specified future date given at specified rate of interest. Thus, it is the amount of money where an investment will grow over the period of time. at some given rate of interest. So here the investors use this particular method to know what will be the future value of their investment after a certain period of time. So in order to understand what actually the future value, we are going to measure this particular present value. See, Mr. A here invest a rupee 1000 for say 3 years at the rate of 10% interest. See, if you go for calculating the future value, the principal amount at the time of investment, see it was 1000 rupees. That is the principal amount. And here we have the 10% is the rate of interest for 1 year. So if you go for multiplying 1000 into 0.1, that is 10% rate of interest, it will be 100. So 100 will be the interest rate that you will get after 1 year. So the principal amount at the end is 1000 plus whatever the interest you earned. Here it is 100 rupees. So your total amount at the end will become 1100. See, in the second year, your principal amount is 1100. Again, we know the rate of interest is fixed, that is 10% here. We are going to calculate the 10% of 1100, which is equal to 110. And at the end of second year, your total amount will become, see, 1210. Now in the third year, at the beginning itself, we are going to calculate the interest on the basis of 1210. So 1210 into the 10% rate of interest, it will become 121 rupees. So you are going to add this particular amount in the principal amount. So it will become 1331. See, this process of calculation is generally known as the compounding, and the sum arrived at after compounding initial amount is generally known as it is the future value. See, however, if you have a longer maturity period, say for example 5 years, 10 years, or maybe 20 or 30 years, then it will become very tedious task to calculate as we go estimated here, just like here what we are already did. Therefore, we can use a formula for calculating the future value. See, the future value can be calculated by using the formula, that is here FV denoting the future value, which is equal to PV, which means it is the present value or it is the principal amount, into 1 plus I raised to the power n. So here it is the future value, PV is the present value, then I is the rate of interest per annum, and n is the number of years for which the amount has been invested. So PV is the present value, FV is the future value, I is the rate of interest, and n is the number of years for which the amount has been invested. See, this formula is actually help you to calculate the amount you invested for the longer maturity period, say for example 10 years or maybe 20 years or maybe 30 years. It's very easily and quickly. So in order to understand the concept of future value, you must also understand the concept of present value, because we are already included the present value in the given formula. So let's see what actually the present value means. See, the concept of present value is just opposite of the concept of future value. The present value is nothing but, see how much your future sum of money is worth today. It is an estimated amount to be spent today to have an investment worth a certain amount of money at a specific point in near future. So simply we can say that it is a current value of the future amount. So the present value is also known as it is the discounted value, and the process of reducing the future income payment to their present value is generally known as it is the discounting. So discounting is the process of reducing your future value into the present value. So here the present value is calculated by discounting the future cash flow back to their current value using the appropriate discounting rate. See, we can calculate the present value, see, by using the equation of the future value. See here, the future value is equal to present value into 1 plus I raised to the power n. Now by using this particular formula for calculating the future value, we can derive the formula for the calculating present value. See, if we are going to divide the both side of the equation by 1 plus I raised to the power n, then what happened? Here the PV will be isolated and the 1 plus I raised to the power n will be cancelled out. Then here in the left side in the denominator it will become 1 plus I raised to the power n. So the present value we can derive from this particular equation, that is the future value divided by 1 plus I raised to the power n. And here, see, we can also rewrite by taking the FV, that is future value, into the outside. So it will be FV into 1 upon 1 plus I raised to the power n. See here, 1 by 1 upon 1 plus I raised to the power n, that is 1 plus I raised to the power n is nothing but we can say that it is the discounting factor, which means that the factor actually reduce the future income payment to their present value. So in this, using this particular formula, we can calculate the present value as well. Let us take some numerical examples so that it will be more clear. See, if Mr. A invest rupee 1000 for say 3 year at the rate of interest of 10%. See, we want to calculate the future value. See here, the present value is given, that is 1000. The rate of interest is equal to 10%. So we can write it is 10%, 10 divided by 100, which is equal to 0.1. Then n is equal to 3 years. So here n is equal to for the time period, which is 3 years. Now we can use the formula for calculating the future value, which is equal to present value into 1 plus I raised to the power n. So we know the present value is equal to 1000, I is equal to 0.1 and n is equal to 3 years. So we are just going to substitute here, then it will become, see, 1000 into 1 plus I, that is 0.1 raised to the power 3, that is cube. So we can simplify it is 1 plus 0.1, which is 1.1 cube. Then if you go for calculating the 1.1 cube, then it is equivalent to the 1.331 into 1000. And ultimately, if you go for multiplying these two values, then it is equal to 1331. So here, if Mr. A is investing 1000 rupees, for example, say for 3 years at the rate of 10% rate of interest, then its future value will be 1331. Now consider another example. Calculate the future value in 15 years of rupee 5000 earning 8% assuming an annual compounding period. So here the future value we want to find out after 15 years, and what is the principal amount? That is 5000, and the rate of interest is equal to 8%, which is compounding annually. So here the present value is equal to 5000, the rate of interest is equal to 8%, which is equal to 0.08. Then n is equal to for 15 years. So we can use the formula, that is future value is equal to present value into 1 plus I raised to the power n. So here the present value is equal to 5000 plus 1 plus I, which is equal to 0.08, that is 8%. So we can say that it is 8 divided by 100, which is equal to 0.08 raised to the power n, that is term, which is equal to 15 years. So if you go for simplifying it, then 1 plus 0.08, which is equal to 1.08 raised to the power 15. So by using the calculator, you can find the value of 1.08 raised to the power 15. It is equal to 3.1721. 3.1721. If you go for multiplying 5000 with 3.1721, then it is equal to 15,860. So the future value of 5000, that is after 15 years, the 5000 will become 15,860 at the rate of interest of 8%, which is compounding annually. Now consider the another example. We want to find out the present value of 1000 due in 5 years of time period at the rate of interest of 8% per annum. See here, what we want to find out, the present value of 1000 rupees Whatever we are solved till now, it was regarding the future value. Now we want to find out the present value of 1000 rupees, which is due in 5 years at the rate of interest of 8%. So what are the information given here? The future value is given, that is 1000 rupees, and we want to find out the present value of 1000 rupees which is to be received in the future, that means after 5 years. So here the future value which is equal to 1000 rupees, the rate of interest which is equal to 8%, so 8 divided by 100 which is equal to 0.08. Then n is equal to for 5 years. Then by using the formula for calculating the present value which is equal to the future value divided by 1 plus I raised to the power n. 1 plus I raised to the power n. So here the future value is equal to, see it is 1000, we are just substituting here, divided by 1 plus I which is equal to 0.08 raised to the power 5. So here we can simplify again, it is 1000 divided by 1.08 raised to the power 5. So what is the value of 1.08 raised to the power 5? Which is equal to 1.4693. So if you go for dividing 1000 with 1.4693, then the present value will be 680.58. So the present value of 1000 rupee which is to be received in the after 5 years is the 680.58 at the given rate of interest of 88% per annum. So in this way we can find the present value. Let us consider another example. See, you are promised of 5 lakh rupees in 40 years by your rich uncle Phil. Assuming 6% rate of interest, what is the value today of Phil's promise? See here, in this particular case, what are the information given? We want to find out, see the present value, the value today. So we want to find out the present value. See, the promise is after 40 years, your value will be 5 lakh rupees. So here what are the information given? The future value is equal to 5 lakh rupees. Then n is equal to 4 years. Then I is equal to 6%, that is rate of interest is equal to 6%. So we can write it is 6 divided by 100 which is equal to 0.06. And the present value we can find out by using the formula, that is future value divided by 1 plus I raised to the power n. Substituting all these values here, then it will become 5 lakh divided by 1 plus I which is equal to 0.06 raised to the power 40. So it will become 1.06 raised to the power 40. The 1.06 raised to the power 40 which is equal to 10.2857. If you go for dividing this, then it will become 48,611. So after 40 years, we will get the 5 lakh rupees, but its present value is now, it is 48,611 at the given rate of interest of 6%. Okay. So these two concepts, that is present value and the future value, are the fundamentals in understanding the time value of money, which are used extensively in the financial decision making and analysis. See, the present value calculation actually help in determining the current value of the future cash flow, allowing for the comparison between different investment opportunities or evaluating cost effectiveness of a particular project. In other hands, we can say that the future value calculation demonstrates the growth potential of investment over the period of time, which helps the long-term financial planning and the goals setting. Now we are considering the another concept related to the present value and the future value, that is the compound annual growth rate, CAGR, compound annual growth rate. See, the compound annual growth rate is smoothed annualized rate of growth of investment or any particular value or asset or amount over a specific period of time, by assuming that investment have been compounding over the period of time. So here the CAGR, that is compound annual growth rate, is usually used to analyze the past performance of a investment or particular amount, which is used to analyze this particular investment plan, such as stocks, mutual fund or businesses which provide a single number that represents the mean annual growth rate of an investment over the specific period of time. Now let us look at how we can find the compound annual growth rate, CAGR, which is equal to, we can derive it from the future value equation. See here, it is future value divided by the present value all raised to the power 1 by n minus 1. It is from the future value and given the present value, you are going to take the whole raised to the power 1 by n minus 1. Or by using the another equation, see here CAGR you can also find out by using, see here it is the expected value, or end value. We can say that it is the end value divided by the beginning value. End value divided by the beginning value whole raised to the power 1 by n minus 1. So you can use, depending upon the question, you can use any of the equation. Now let us take some examples so that it will be more clear. We want to calculate the compound annual growth rate from the given table. See the given table, the year is given from 2015 to 2018 and the asset value in the 2015 was 20,000 rupees and it is increased to 25,000 rupees in 2018. Now we want to find out the compound annual growth rate. See here, the end value is equal to 25,000. So the end value here in 2018, that is 25,000. What is the beginning value? See here it is starting from 20,000. So our beginning value is equal to 20,000. And here the number of period, it is 4 years. 1, 2, 3, 4. 4 years are there. So n is equal to 4. Now let us consider the formula for calculating the compound annual growth rate, which is equal to the end value divided by the beginning value whole raised to the power 1 by n minus 1. Just substitute all these things here, then it will become, see the end value, that is 25,000 divided by 20,000 whole raised to the power 1 by 4, n is equal to 4 minus 1. If you go for simplifying it, dividing 25,000 by 20,000, it is equal to 1.25 whole raised to the power 1 by 4 minus 1. So if you go for calculating the value of 1.25 raised to the power 1 by 4, see it is equal to 1.05737 minus 1. Subtracting the 1 from this particular value, then it is equal to 0.05737. And what it is showing, that if you go for multiplying with 100, it will become 5.737. The compound annual growth rate over the period of time, that is here the annual growth rate over the period of time is given with a single value, that is 5.737. Now consider another example. See, suppose you have invested 10,000 in stocks and after 5 years your investment is grown to the 15,000. And we want to find out what actually the compound annual growth rate is. See here, the present value is 10,000 and the future value is 15,000. And the n is equal to here for the 5 years. And now we want to find out the compound annual growth rate. So we can find out the compound annual growth rate by using the formula, that is future value divided by present value all raised to the power 1 by n minus 1. So all the values are given here. So you just simply substitute all these things in the given formula. Then it will become 15,000 divided by 10,000 whole raised to the power 1 by 5 minus 1. So if you divide these two terms, then it will become 1.5 raised to the power 1 by 5 minus 1. If you go for finding the value of 1 by 5 whole raised to the power 1 by 5, then it will become 1.0844 minus 1. So if you subtract the 1 from this particular value, then it is equal to 0.0844. See here, if you go for multiplying with the 100 so that we can express this particular value in terms of percentage. So here this compound annual growth rate is equal to 8.44 percentage. Now consider the another one. A firm decided to increase an output at the constant rate from the current level of 50,000 to this 60,000 during next 5 years. We want to calculate the annual rate of increase required to achieve this particular growth rate. So in order to achieve 60,000 from 50,000, how much growth rate is needed? So this is the question here. So what are the information given? The present value, that is 50,000, future value which is 60,000, and the number of years which is given for next 5 years. So n is equal to 5. And we want to find out the compound annual growth rate here. So here it is equal to future value divided by present value raised to the power 1 by n minus 1. So just substitute all these values here so that we can calculate the compound annual growth rate, which is equal to 60,000 divided by 50,000 whole raised to the power 1 by n minus 1. If you divide these two terms, then it will become 1.2 raised to the power 1 by 5 minus 1. If you go for finding the value of 1.2 raised to the power 1 by 5, it is equal to the 1.0371 minus 1. Subtracting 1 from this particular value, it is equal to the 0.0371. If you are converting into the percentage term, then simply you have to multiply with 100, then it will become 3.7 percentage. 3.7 percentage. So how much annual rate of increase is required to achieve the 50,000 to the 60,000? It is 3.7 percentage growth rate is needed. So let me conclude here. Today we have discussed what actually mean by the present value and the future value for measuring the time value of money. In the next lecture, we will introduce a financial concept, that is annuities, and how to find the present value and the future value of various types of annuities, just like ordinary annuity and annuity in due. So we'll see in the next lecture. Thank you.